Ladies and gentlemen, good day and welcome to the Q1FY26 earnings conference call for Bajaj Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajit Kumar from JM Financial. Thank you, and over to you, sir.
Thank you, Darwin. Good evening, everyone. This is Ajit Kumar from JM Financial. Welcome to 1QFY26 earnings conference call of Bajaj Finance Limited. On behalf of JM Financial, I would like to thank the management of Bajaj Finance for giving us this opportunity to host the call. From management team today, we have Mr. Rajeev Jain, Vice Chairman and Managing Director, Mr. Sandeep Jain, Chief Operating Officer and Chief Financial Officer, and other senior members of the management team. We will have opening comments from the management team, post which we will open the floor for Q&A. With that, I would like to transfer the call to Rajeev sir for his opening remark. Over to you, sir.
Thank you, Ajit. Thank you, JM, for hosting this call. Good evening, all. I have with me my colleagues here. I have the three deputy CEOs. I have the two chief operating officers here. I have the CRO, and I have the few of my president colleagues. I'm referred to the certain page sections of the investor deck, which has been uploaded on the website. I'll be referring to that. Let's just jump right over. Let's go to page 4. That's on quarter gone by. Overall, I would say it's a good start to the year. A good quarter on volume, assets under management, OPEX, profitability, ROA and ROE. Credit costs still remained elevated in Q1 as well. Overall AUM growth came in at 24,789 crores to 4,41,450 crores. We booked a record 13.5 million loans and added 4.7 million new customers in Q1. Customer franchise stood at 106.5 million. As we've just outlined in the AGM as well, we had record 650-700 people in the AGM today. I think in terms of physical presence, that we believe that FY26 will be a defining year for a FinAI transformation, a strategy that we outlined in December or January quarter to the shareholders. And FinAI capabilities, I can just tell you, have started to go live across the company, both below the iceberg and soon on the digital assets as well. You will start to see it. Right back to financial numbers. AUM grew 25%, OPEX to total income came in at 32.7%, PBT grew 21%, PAT grew 22%, and ROE came in at 19%, and net NPA came in at 50 basis points. Just some quick points on page 5. Geographic footprint stood at, I'll cover points that I've not covered. 1 to 3 are covered, 4 are covered, 5 are covered. 6 geographic footprints stood at 4,192 locations. Gold loan branches stood at 1,254 locations, and MFI dedicated branches are now 337 branches. We added 85 standalone gold loan branches in Q1. Active distribution footprint is at just a tad below 240,000 distribution points. Important point to cover is liquidity and cost of funds. Liquidity buffer stood at just a tad below 15,000 crore as of 30th June. Cost of funds came in at 7.79%, an improvement of from a sequential standpoint of 20 basis points. In FY26 overall, we estimate cost of funds to come in at 760 to 765. This is not taking into account any further cuts that may come at this point in time. However, on the other hand, what you will see correspondingly is that the deposit contribution to the balance sheet may go down to 17% from where it was 20% to at this point in time at 19%. It will probably go down to between 15 to 16%. It's possible depending on the growth momentum. So for the next 12 months, there will be high reliance on NCD, ECB and bank borrowings to ensure we deliver rightful cost of funds to the business. On panel 6, NIM grew 22%, net total income grew 21%, OPEX to total income I've talked about. We started to deploy AI capabilities to improve productivity. Employee headcount stood at 65,528, and employee attrition in Q was 16.9%. Little higher than what it was on a year-on-year basis. It's higher by 100 basis points. 100 basis points, I think. The first term contract staff stood at 44,335. Credit cost, there are 5 points I do want to cover all of them here. That at a firm level, what we see is that consumer leverage continues to remain an area of concern. Company across lines of businesses continues to take several actions across all products to reduce contribution of customers with multiple loans. That's the single univariate pain point that we have identified, which has a significant high bearing on loan loss and provisions. So business by business, since January we've been pruning. In most businesses, we've actioned what we would have wanted to do, except in MSME, which is still work in progress. Loan losses still grew by 26%, came in at 2.02% in terms of loan loss to average AUF. Credit costs were principally elevated in two-wheeler and three-wheeler business, which is a winding down business. That's a good news. It is the captive book has given us a lot of trouble, or continues to give us trouble. It will wind down to virtually 3,500, 4,000 by March 26. MSME business has shown some strain since February, so it's come in a little too suddenly. We've taken a whole host of actions to prune business. It's likely that both these businesses will grow lot more slowly in the current year, starting second quarter. In point number 20 is important. The overall stage 2 and stage 3 assets came in at 878 crores. You have to keep that in mind, that of that, stage 2 assets increased by 324 crores, primarily on account of these MSME customers to whom, to mitigate their short-term cash flow issues and to assist them, we have begun to offer them restructuring options. So close to 219 crores. 219 crores of customers were assisted with a restructuring option.
Who were in standard account?
Who were standard account, but who were offered restructuring, and relevant provision was taken on these clients. On panel 7, we are, as I said, except MSME, the metric that we're looking at is not current portfolio. The metric that we're looking at is what is the 3 MOB, 6 MOB, 9 MOB and 12 MOB of the business since January, February this year. If we see improvement, the book itself churns fully. The behavioralized maturity of the consolidated book is 22 months. Standalone book is 19 odd months. The standalone book is 19 odd months. If the early vintages improve, then it's just a matter of time, everything will improve. So 3 MOB and 6 MOB we have started to see, and the principal track there is go back to pre-COVID levels. That's a high bar that we have set for ourselves. We will get there. GNPA and NPA stood at 1.03 and 0.5%. Profitability, I've talked about. ROA, I've talked about. ROE, I've talked about. Capital adequacy remains strong. Tier 1 capital was at 21.19. Just two more updates before I go to a few panels later. Was the conversion of bonus and split that happened on 16 June 2024. As you're aware, we've done a announcement as well that my colleague Anup tendered his resignation as MD and Director of BFL for personal reasons, and board and upon the recommendation of NRC have noted and accepted the resignation, and we wish to place on record our sincere appreciation for Anup's valuable contribution during his tenure. He spent 7.5 years with the firm, and extend our best wishes for his future endeavors. To ensure continuity, unfortunately I had said last quarter that this is my last call, but to ensure continuity and to ensure stability of the firm, I have had to come back as in an operating role. I don't want any ambiguity on this. till March 28. Closer to that, we'll take a view on what is the succession planning. Of course, board has asked us to create a succession plan, but because we don't want any ambiguity, given the growing size and complexity of the firm, you will get to know about any change only closer to March 28. More. Quickly for BHFL, balanced quarter. The results were published yesterday. Good quarter for them. Assets, but there's intense competitive activity. I'm sure Atul has talked about it. I'll just cover only this panel. Intense competitive activity is leading to pressure on volumes and leading to pressure on attrition. So this level of intense attrition we have not experienced in building the mortgage business out for the last 15 years. Having said that, I think company did a commendable job. PAT grew 21% and delivered ROE of 2.3% in line with Q1FY25, and asset quality remained healthy. More. Quickly on BFSL, small company but continues to make good progress. Good quarter in AUM, PAT and new customer addition, delivered AUM of 6,100 crores, PAT grew 37%, and they added 77,000 customers to the franchise in Q1. So they continue to remain steadfast. We are on course to, last year the company grew in terms of its 4-year-old company. It should start to come into being as we traverse this year. Let's go to, I'm on panel 29. These are overall financials. I think I've covered everything here. There is one question that you may have, which is on the others line item, which looks on a year-on-year basis 23% lower. It's mainly last year, same time we had sold, and they had done an NPA sale. This quarter we have not done any. So that's the reason you're seeing that number go down. Sandeep, any other number that you want to capture? So that
the other number is the net gain on fair value change, where we have 79 crore rupees of additional gain on account of NTM. That's one thing. And second, we found Q1 to be very, very attractive given that rates were being cut to park money in mutual fund. All the gains on mutual fund sits in the this particular line versus sitting in the interest income line when we park money in government securities. As a result, you may see some level of small compression in margin. It's mainly on account of this. Adjusted for this, the number is flat on a sequential basis. On a sequential quarter basis. I thought I'll just make that point. Rest all the numbers have been talked about. Move. I've gone to panel 41. This is a customer franchise. We continue to make good progress. I think the top of the funnel is extremely important. As long as we continue to originate customers through the door, even at this size, I think we have the product range to be able to meet all the financial services needs of the consumer. So the top of the funnel continues to remain pretty active, ensuring that we have a strong roadmap ahead of us. Move. I've jumped to panel 46. This is the consolidated AUM composition. In general, on a year-on-year basis, you hardly see any movement. You see, we have just organized this in the order of high to low. So mortgages is the largest portfolio, followed by urban B2C, followed by MSME, followed by. So this is a new frame that you will see. It's in the order of highest to lowest. Highest in mortgages and MFI is the lowest at 0.4% of the balance sheet. Gold loans is now 2.3% of the balance sheet, and the largest balance sheet on a consolidated basis remains mortgages at just a tad below 31%. On a year-on-year basis, other than two-wheeler and three-wheeler, which you are seeing degrowing, there is no composition change in the balance sheet on a year-on-year basis. Actually, if you took even a 3-year view, you will other than two-wheeler and three-wheeler, which is as a result of winding down, you will not see too much of a change. Maybe 2% during this period, the balance sheet has more than doubled. I'm on panel 49. You see GNPA moving marginally on both sides, but the biggest movement is in two-wheeler and three-wheeler. As you can see, on a year-on-year basis, moved from 3.4% to 6.38. It's a little confusing number because the balance sheet is winding down. That's an important point I must make. That it's a number which is, but the absolute loan losses basis our estimate and plan were also ahead by 70-75 odd crores in a winding down book.
So that's not necessarily a good news. The only other second line that I would outline is MSME lending, that on a sequential basis moved from 1.48% to 1.76%. Otherwise, the impact of rest of the moment is not. As you can see, urban sales finance was flat, urban B2C is 5 basis point movement, and so on and so forth. But you see MSME move sequentially from 1.48 to 1.76, and two-wheeler and three-wheeler move from 5% to 6.38% move. I think that's really all. This is panel 53, just last three panels which cover portfolio quality. The reason they are stamped white and two-wheeler, three-wheeler is because of winding down book. While open architecture is also sitting there, but a year ago the captive business used to do 65,000 accounts. Right now we are doing only 35,000 accounts, given, as I said, the entire focus on MOB management or early MOB vintages. We want to be at a design level half of what we used to be in the captive business. Let me make that point reasonably clear. That is really what our intent broadly is. Over cycles, the business used to give a 5% loss rate. We want to run the business at between 2.5% to 3% loss rate. That's really what our focus is. So that's just one point I want to make. Panel 55. Business and professional loans, rightfully, as you can see, this number even in February 20 was 99%. Right now it's at 98.25% current. It has moved little too quickly for our comfort in the last 4 or 5 months, and we are navigating through this. Rural B2C, it's not yellow in that sense, but because it's lower than it used to be earlier. There, the only point I would make is adjusted for Karnataka, which has caused trouble in all rural parts of our businesses, not just rural B2C. And Karnataka, unfortunately, is not a small contribution. It's 11% of the total balance sheet. So is Maharashtra, which is higher. So is Tamil Nadu, which is higher. So if any of the large southern states see a change like this, it does have unintended impact on the portfolio. We've stopped doing some of the businesses. We have cut business by 40-50% in Karnataka, because for the first time we are experiencing what I would call political risk, which we don't know how to navigate. We can't even stop business, but we can't also continue business. So it's a little tricky place. So wherever we are able to prune, we have pruned. MFI at this point in time we have stopped, and we have cut business by 35-40% in two-wheeler, urban, rural B2C, even urban B2C, even rural B2B. So we are watching. Move. Rest is all fine. MFI is not yellow, it's green. That's fine. It's okay. 100% will have to go down only. So move. That's it for me. Happy to take questions between me and the management team, whatever you have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question comes from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, thank you for the opportunity. Rajiv, I have 3 questions. But first, to begin with, I would say it's glad to have you back, but just wanted to understand what have been the learnings of, say, this transition process we had planned, I would say, 2 to 3 years back, and what is it that incrementally you have in mind as to how to approach this, say, 2-3 years down the line, so that we see a more smoother transition? That would be my first question, and then I have 2 to 3 questions on the business, if I may.
Viral, the only point I would like to make is that every incident must have learnings and a course correction plan. There are learnings that we've taken. The NRC and the board have extensively discussed this matter and have provided necessary guidance. I have to go back to the board and the NRC in the next 6 months' time with a with a detailed succession planning process. Is all I would like to comment at this point of time on this point, Viral. And I hope you appreciate the sentiment.
Get it. Very fair, Rajiv. My second question is more for Sandeep. Sandeep, on the financials front, when I look at, say, your the cost of fund guidance that you have given, say now 15 to 20 bits is the reduction that you anticipate for the year, given that's the movement that we are seeing from 4Q to 1Q. Do we now anticipate, say, a 5 to 10 bits kind of a NIM expansion on a full year basis versus flat earlier?
Yeah, I think, Viral, this question was asked last quarter as well. We had given a guidance on flat NIM for the current year, and given the trajectory of rate cuts that we are seeing from RBI, we did comment that there could be a 5 to 10 basis point of positive bias on the NIM number. Given that there has been 50 basis point rate cut in the last round and the 20 basis point overall improvement in the cost of fund that we are seeing in the current quarter, I think we are reasonably confident that probably 10 basis point of NIM expansion could happen by end of the year.
Got it. And secondly, Sandeep, on the, say, your growth guidance numbers on the non-interest income and also the credit cost for the full year, are they broadly still, do you retain them, or how do you see them panning out?
So, I think on the fee income side, we have guided for 13 to 15% for the current year. We did allude in the last quarter's earnings call as well, that we have taken significant actions on fees and charges in the previous year, which will have a full year impact in the current year. As a result, there will be a reset to 13-15% number in the FY26 outcome. That continues to hold true. As far as credit cost is concerned, I think 2.02% as a number for the current quarter was 5 basis point higher on a sequential basis, largely flat on a YY basis. We continue to hold 185 basis point of guardrail for the current year on a full year basis. You will see a sideways movement probably in Q2 if all goes well, and probably a decline from quarter 3 and quarter 3 onwards. Having said so, I think one of the important driver will be the auto finance vertical, which will start to become smaller and smaller quarter by quarter. That itself will start to give 5-10 basis point improvement to us on the overall loan loss to average number.
Last point I do want to make that, the fee income grew 17%, just to add to what Sandeep is saying, because B2B had a much stronger quarter. So that's why the volume momentum is a little better. Otherwise, to the point Sandeep is making, overall guidance is for 14-15%.
And last year's quarter was partially impacted by embargo as well. So to the extent on a YY basis, the numbers are not necessarily comparable. I think 13-15% as a number for full year is probably a rightful expectation to have.
Got it. And my last question, Rajiv, is for you. So on the SME portfolio, you pointed out that we are seeing meaningful stress. Can you point out which sub-segment within this is showing this? Is it, say, unsecured business loans or LAP or term loans? And are we also seeing, say, percolation of stress from unsecured to secured segments, like in gold loans and home loans?
Not between unsecured to secured. Anyway, it's a tail effect. The secured gets a tail effect. Let me make that point. That does not mean it won't come to secured, because what we find, as I said earlier in the call, is that more number of loans is a single univariate driver now, and that may include secured and unsecured both, or unsecured and secured. But let me just spend 2 minutes on MSME to make the point. We principally track 17 key industries in MSME, out of which 13 that we are seeing are exhibiting signs of slowdown. And 3 actually, so in a way it's all 17, it's other than 1, 3 are actually showing contraction. So clearly slowing economy and a drop in credit supply is, at one level, is good, because when we used to look at the business loan lending, we used to wonder the market is not large enough to be of that size. But so from a longer term standpoint, it will give lessons to everybody. Some lessons we'll also learn in the process. But I must make a point that market is not that large, especially for business loans, to grow from, pre-COVID the market used to be 2,500-3,000 crore. It's grown to 11,000 crore. Right now it's at 9,500-10,000 crores a month. Sorry?
come down to 7,000. So it's contracting. So, but that contraction to begin with troubles and then starts to be better. Is the only point I would make. So we are looking at early vintages and just going about it.
Got it. Makes sense, Rajiv. Thank you so much.
Thank you.
In fact, Viral, in the same context, I think it's important that we call out MSA business will see one of the slowest growth in the current year. And of course, auto finance is initially in rundown mode. These are the two lines of business which are where we are taking actions.
Got it. Very clear. Thank you so much and all the very best.
Thank you. Our next question comes from the line of Piran Engineer from CLSA. Please go ahead.
Hi, congrats on the quarter. Actually, my question was kind of answered here where you mentioned that it's more to do with economic slowdown. But just to get more clarity on unsecured business loans, are these, how do I think about leverage at that promoter level? Because he might have taken a business loan from you, but a personal loan from some bank, etc. How do you think about that, and like any statistics you can share there?
No, the only way to do it is to offer him remediation. That's why, as when I talked about it, we never did restructuring. But that's the only thing that we can do for a customer who's honest, but who's principally got, if I may say so, leveraged. And mind you, we all know it that MSME is as financial literate as it gets. So the only thing to help him is for good guys who are going through, intermediate period of stress, is to offer them restructuring. We've done 214 odd crores. We may do another 150 odd crores over the next 1 odd quarter, and from there on it should settle down. Not that we never used to do. We used to do in a quarter 40, 50 crores. Okay, but that's the only thing, Piran, that can be done. Tighten lending standards, 1. 2, help the customer with restructuring option to reduce his outflow, and hope to not repeat it again.
Okay, fair enough. And also on the B2C side, earlier we used to share metrics on what percentage of the portfolio had 3 or more lenders. I believe it used to be 7-8%. Sorry?
4% now. 4%. And that is what it used to be.
7-8% pre-COVID?
No. It was 5.5%. It is down to 4.
And it went up to 11-12, right?
Yes, that we have published. Yeah. Perfect.
So now it's 4. Okay.
Yeah. All businesses, this metric is being tracked. The only thing, and where we have got partially, if I may say so, a little stumped, because the BL business even pre-COVID used to have 14-15% of the customers who had multiple loans. This is a working capital loan rather than a consumption loan, a BL loan. So it was very common, and I have done business loan for 30 years. A customer gives a file not in 1, in 3 places. So we know that he does take in general. So 14% of customers used to have multiple loans. That went all the way to 21. We have now brought it down to 17. And we are watching it. It is a univariate metric even for BL that seems to be working. Leave a consumer loan. So it's in a card business like multiple cards, it's multiple loans and multiple business loans.
Okay. Fair enough. And just lastly on growth or just in terms of scale up, in car loans, like what percent? I'm just trying to think about our distribution reach right now in car loans.
We are in 60 cities.
Okay.
Yeah. Go ahead.
I thought you said the loan book is very small. I just want to get a sense of the distribution reach and like how big we can become over the medium to long.
It can be very big. Piran, the issue is used car and new car put together must make 13-14% ROE. If it doesn't make, I can grow the business of new car. It took us 5 years to get to 300 crores. It took us only 1.5 years to get in used car. It is down to 200 right now, given the pressures in used car in the last 6 months. New car is holding very well, I must say, but there is very little money to be made. So we have artificially held the business at 350 crores of new origination a month.
It is not allowed to do more than that.
Got it. Okay, that's it from my end. Thank you and wish you all the best.
Thank you.
Thank you. We have our next question from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So sorry, again, touching upon the leadership transitioning, you indicated that the board has indicated that over 6 months you need to give a detailed succession planning. But at the same point in time, you indicated that to avoid any ambiguity, it will be closer to FY28 wherein the plans will be revealed. Is that correct? So maybe over like 2.5 years, it will just be again like preparing the transitioning. But last time, maybe 3 years back, we made it public in terms of how it is happening. But I think this time it will be more internal and it will not be made public. Is that the correct reading?
Yes. As Viral said, what are the learnings? It's one of the learnings.
Okay. But anything with respect to the corporate structuring, maybe it was quite multi-layered in terms of like, say, many changes have happened. So would we...
structure, Kunal, there are no changes envisaged at all.
No changes in terms of the corporate structure which has been planned or maybe which was indicated over the last couple of years.
Yeah, none.
Yeah, sure. And secondly, with respect to MSME, so you indicated maybe that's going through this phase. But when we look at it in terms of the recognition where we are and provisioning also, I was just looking at it maybe in terms of the coverage ratios across stage 2 and stage 3 it's coming off. I believe that it's because the newer pool which is sitting in that and which would call for a lower provisioning. But then maybe with the seasoning of the portfolio, do we see again the provisioning requirements going up in the MSME because of the stress you had indicated?
The overall provisioning coverage ratio has multiple facets, including the composition of the overall balance sheet, because different products have different coverage ratios. That's one thing. Second, as Rajiv alluded to, we have done 219 crore worth of standard accounts restructuring. These accounts generally carry a lower provisioning compared to normal stage 3 accounts. That has also pulled down the overall PCR number from 53.73% to 52%. So that's the only reason. Otherwise, there's no structural change in the provisioning coverage ratio.
So fair to assume this restructuring is in SME because that's the only SME and commercial lending is the only place wherein provisioning coverage is coming off. I believe commercial lending is more of a recovery, but MSME is because of restructuring.
Yes, it's MSME mainly.
Yes.
Okay, got it. Perfect. Yeah, thanks a lot. Yeah.
Thank you. Our next question is from the line of Concall Shah from Oaklane Capital. Please go ahead.
Hi, thanks for taking my call, and Rajiv, thanks to have you back on the call. So we heard Bajaj has tied up with Airtel, and which was supposed to accelerate your customer franchisee and increase the reach also. And LRS also talked about 200 million kind of numbers targeted. But when you look at YOY, our customer addition momentum has slowed down, and so has cross-selling. I believe from 3.8 to 3.2 and 3.3 to 3.1. Can you throw some light on that? And second is, you said AI is a transformative year this year, 2026, but we see insurance, AMC, healthcare, etc., all sitting in parent, broking, distribution, lending sitting in your company. So how does this work, AI strategy, in terms of synergies, cost reduction, cross-sell? Shouldn't it be a common stack and, common outcomes, and how do you achieve that?
Yeah. So, Kuntal, a 4.7 million new customer acquisition after last 2 years of record 15 million and 16 million, even I'm a little surprised that time. Thank God, desh mein population hai. I mean, okay. As much in a lighter vein as on a serious point, I think we build distribution which is able to generate that kind of top of funnel. Mind you, in the private sector, there will be only 2-3 players, and we are much younger, who are above 100 million franchise. And we can see a clear roadmap ki, yes, this year will probably end at 120 million. So that's just one. This will be the run rate, Kuntal, between 14 and 16 million, plus minus, is how you should pencil the number. We are working on strategic partnerships and so on and so forth. So there's lots in the there's a lot of dry powder that is being, still being built to ensure that we can generate this momentum. So whether it is just, let me give you texture on this as to one is strategic partnership. Second is, you could not take a CD loan approval on the app. You could always take earlier. The approval rate used to be 5% because the risk engine used to be distinct from that of what runs at the store. Now it was a very complex, technically very complex architecture, which took us, if I may say so, a few years to build. We've taken 18 months to build that out when it struck us that this can be a large engine, that not everybody wants to buy an InstaEMI card. Some people may just want to take a phone loan for a phone and so on and so forth. It has just gone live on the app for 10%.
We are right now at 15%.
15% of the customers. We foresee that this could give us 2 to 3 million new customers a year who would take the approval on the app exactly for the same product, walk into the store and out in So we are continuing to invest in top of the funnel to make sure that it remains active and energized. On the second point, Kuntal, the way the group is organized it's a federal structure. We allow companies to be independent. We allow companies to make their own decisions. Some of the companies which have larger profit pool are significantly and profit pool leads to investment pool leads to ability to deploy. As I just presented in the AGM, 150 people we dedicated on January 1 to AI. Not too many companies would have the profit pool to deploy that level of talent on a given day. But we are there to assist group companies and we are assisting them as they traverse through their journey on AI. But we will lead the way is what I can reasonably tell you. Does it answer, Kuntal? Partially, mostly?
Partially, yes, but common unified super app was what I think makes sense from tech perspective, right?
Okay, so let me make that point. If you're an Apple now, if you go to share market on the app, you are seeing very tightly integrated, and in the next 3 months it would have you would be able to see a portfolio on a static basis in the app. BALIC has gone live on our app. See, our app to that extent will be is the super app, if I may say so, because it will have ending this year 90 million customers. It has the distribution infrastructure, and in the process of working with the respective group companies, they are elevating their standards. If that is what you mean indirectly, let me make that point. It has helped elevate BFSL because they didn't have this infrastructure of this scale. With BALIC over the last 9 months, we've done the same thing. So we are working company by company. We've gone open architecture on home loans, let me tell you. If you go to our app, you will actually see that we offer 5 home loan companies, not just group company. We've gone open architecture. It is, I never use the word super app, but my ambition or our ambition as a firm in 2020 was always that. But I always told people, you don't make super app, you become super app. I think there is a distinct difference. You can't say I want to be super app. You have to do a set of things over a long period of time. So like government services has just gone live. You can access a whole host of government services, I think ending July, whole host of government services you can access on the app. Now that's really what Alibaba, and when we looked at it in 2020, we never talked about it. That's what we looked at. That Alipay was offering a whole host of government services integrated. So Abha ID to, ONDC, we're now doing 30,000 orders a month on ONDC. So I think we will become super app one day if we stay at it, So and
Rajiv, does it mean you will tie up with more fintechs which have a lot of customers in payments, in moving money from A to B?
No.
With no profit pools and nothing like that, because you have profit pools.
No such thing. No.
Okay, thanks.
Thank you. We remain focused on financial.
Best.
Thank you.
Yeah, thank you.
Thank you. Our next question is from the line of Abhishek M from HSBC. Please go ahead.
Yeah. Hi, good evening, and thanks for taking my question. Good to have you back, Rajiv. So the first one is going back to SME. Can you give some color on the book? How much of it is unsecured? How much of it is professional loans? And are those the parts where you're seeing basically maximum stress? Also, what are the credit actions you have taken? So any examples you can give that will help us understand, what's happening. And the third is is it going to remain slow, or there are sub-segments or some other segments there which you can accelerate going forward?
As I said, Abhishek, at this point in time, it will remain slow only. I think, as I said, 17 industries we track, 13 are showing slowdown and 3 are showing contraction. Right. The credit supply has got choked. So it's virtually a perfect storm in a way, and it's come too suddenly. Let me make the third order point, that it's come a little too suddenly. So that itself doesn't prepare you for it. But it is what it is. Thankfully, we are reasonably diverse. In that, let me tell you, to the point you asked a rightful question, that just go to investor deck. MSME portfolio is 60. Just go to
50,000 crores.
50,000 crores. In that, principally, doctors is 15,000. Doctors is 15,000 crores. Even there we are seeing pressure. Let me tell you. So this segment did not trouble us even in COVID actually. I mean, they went slow, but they never. This segment is also suddenly troubled us. 52,000 crore out of that 50. What you see on panel 46, the 15,000 crore is doctors. It's virtually a $2 billion business. You run that for 15 years. It has always been 99% current kind of portfolio. So, but that problem is smaller than MSME. Let me make that point. The BL problem is little more pronounced. But what we are doing is, as I said earlier, MOB. From bounce to 3 MOB to 6 MOB to 9 MOB, and that is not just for. I'll reinforce the point. That is not just for SME, for across businesses. Since February, I would say we are going hammer and tongs, and we don't care about what does that mean to growth. We have to just this is what it has to go all lines. 3 MOB, 6 MOB, 9 MOB, and 12 MOB have to go below pre-COVID.
Okay. How much would be the total unsecured in this book? In the 50,000 crores?
Entirely unsecured, Abhishek.
Entirely unsecured, right? Nothing.
The mortgage sits in mortgage and so on and so forth. So if you see in that panel, you see BFL mortgage, right? So you see 27,000 crores. So and so on and so forth. So the classification is exactly as it is.
So the other,
yeah. Sorry. Go ahead.
Sorry. Please go ahead. Sorry.
No, go ahead.
No, so the other observation I had is that since it is mostly unsecured, typically when you see an unsecured GS2, GS3 provisioning, it jumps from 40-50% in GS2 to around 70-80% because, a lot of it flows forward. But in MSME, it's, 42 going to 49. So there's not much provision build-up that's happened in the book, when it's flowed forward from GS2 to GS3. So is it safe to say that build-up will happen given that most of the forward flows are unsecured?
Abhishek, that's what I was trying to clarify earlier as well, because the number of customers who have been, or amount of customers who have been restructured from stage 1 and have been accordingly classified as stage 3 has actually pulled down the provisioning of stage 3. These customers have higher probability of revival, and that's the reason why those customers were chosen for restructuring.
That is exactly
understood. Yeah. Okay, got it. The second question is on growth. So if I put all the comments together, so BHFL has also indicated slightly slower growth this year. Obviously, MSME is slowing. 2-3-wheelers will remain slow. So are there any other segments where you're looking to pick up slack, or do you think 26 by nature is going to be a slow year, and then you get back to your medium-term growth trajectory in 27. So 26, you will probably underachieve or be lower than that growth trajectory. So how are you thinking about it?
I would wait for one more quarter, Abhishek, before we give you a very clear view. Right now, I would hold between 23 to 24%, but we would also have a clearer view as we complete Q2. So just hold your breath for Q2. And number 2% ही plus minus हो सकता है, ऐसा कोई बहुत बड़ा change की बात नहीं कर रहे, but you guys are used to guidance now on decimal, so I am talking percentage. So I have to manage expectations, so we'll
sure. Okay. Thanks so much. Thanks for taking those.
Thank you.
Thank you. The next question comes from the line of Chintan from Autonomous. Please go ahead.
Hi, good evening. Thanks for taking my question. So, can I come back on the NII? Like, if I see this quarter, 4.8% growth in NII, 5.9% growth in AUM. So implicitly, it's a 10 basis point NIM decline. You highlighted this mutual fund investment. Is that the liquidity buffer which has gone down 20% that's been parked in that mutual fund investment that's causing this NIM decline? And how long will you hold that on the book?
Yeah, you're bang on, Chintan. I think the liquidity buffers were deployed more in terms of mutual funds in the last quarter, and the mutual fund income goes and sits in a separate line item, which is net gain on fair value change. Adjusted for that, NIM was largely flattish on a QOQ basis.
And how long will you hold this position? Is it duration of 6 months?
I think that was specific for quarter because as the rates were coming down, the mutual fund returns were far better compared to government securities. So we moved money from government securities to mutual funds, locked those gains, and then we have moved back the investment into government securities and T-bills, which is what we normally do.
So, Sandeep, why should this go back up? Because if it becomes liquidity buffer again, it will go into GSEC, which is also lower NII, lower NIM. So, why should there be is it just the denominator?
It will go into interest income line, right? What you see as NIM, interest income as interest cost, right? So, it will go into interest income. Cost is always sitting there.
Fair enough.
Some is sitting somewhere else.
Then the second one was on MSME. You gave some numbers, 2.5 went to 11 and then came down to 7,000 crore. What were you talking about? Are these monthly disbursements you're talking about on MSME?
Yes. Of business loans as published in bureau. Yes.
Monthly disbursements. Okay. And, do you have a view on why this has happened? Because we haven't heard any of the other kind of banks talk about it. You're talking about it as a clear pain point, not just for yourself, but also the industry. So just wondering, if you have some visibility on, is it the customer group that NBFCs target versus banks, or is it something specific that you are seeing?
Look, business loans we've done for 18 years. We have seen, other than one lender in the private bank space who has done this consistently, we are the only two lenders who have done this consistently over the last 18 years. This is a business which is 2 steps forward, 1 step backward, 2 steps forward, 1 step backward. That is how the nature of the business is. There's nothing to read into the business. Is it a little bit of over exuberance? And this segment takes, unfortunately, let me make that point, this segment does take what is offered. It is, as I use the word politely, that it is as financial literate as it gets. So it is leverage that you should read as the principal driver. But it's come a little too suddenly. It didn't come slowly. It came a little too suddenly. Is the only point I would make. We are also a little surprised by it.
I mean, it's primarily unsecured, so I suppose that's why the banks aren't talking about it. But, what do you see as the turning point then? What causes it to kind of improve? Because the slowdown that you talked about on the macro is very broad-based. We can see it in a lot of economic indicators, and it is it's already slowed down quite a lot. So I'm just wondering incrementally, how does this evolve over the next kind of 6-9 months?
I think, as I said, Chintan, earlier, we are just focusing on early MOB. As the portfolio churns, this will improve. That is the only way. And that's why I said this is likely to grow probably single digit. AUM may grow 15% as Siddhant is saying, but in terms of disbursement growth, we are going to be flat stroke lower for the rest of the year.
Okay. And the final one, perhaps, for Sandeep, could you just give us some sense of how much of the rate cut has passed through the liability side already, and some color on the asset side as well? But asset is slightly easier. Liability is where I would like some color.
Yeah. So the liability side, very clearly, NCD has seen almost 90 basis point of improvement in rates. We were borrowing NCD at 8% corridor. We are now borrowing between 7 and 7.1 mostly. That's one. So clear pass-through has come in, but that's for incremental, right? So old books, it's at old rate only. Banks, we have 85% of the bank money is on external benchmark rate. That has seen transmission as we speak today, full transmission of 100 basis point. And the balance 15% of bank monies are on MCLR, where partial transmission so far has come. CPs get repriced very quickly. It's market-driven instrument. It all depends on liquidity position, etc. We have seen 80 basis point, 90 basis point improvement in CP rates as well in the recent times. So pass-throughs have started coming in liabilities, but because the liability book also needs to churn, the overall improvement that we have seen in Q1 is 20 basis point. The pass-through on assets also is moving in tandem. So all the customers who are variable in nature, if they are linked to repo or external benchmark, they have seen the full pass-through. If the customers are linked to Bajaj FRR, they are seeing the pass-through as the cost of fund for the company is easing out, which is how banks transmit MCLR cuts as well. As a result of that, the margin for Q1 remain broadly same as Q4. Q1 remain broadly as Q4.
Okay, so the NIM improvement is now driven by the better liability transmission as we go forward.
Yes. Just to reinforce the point,
Thank you so much
that's why the decision even on slowing down deposits, so that whatever gains we can accrue.
In fact, that's an important one. I forgot to make that point. Deposits, we were originating almost 1,500 crores of deposits on a monthly basis. Retail deposits. We were paying probably 70-80 basis point higher than the monies that we are borrowing through a combination of bank and NCDs. We have priced now retail deposit exactly the same price as the NCD and bank money is for us. As a result, the volumes have come down for now. It's at 1/3 the volume where we were earlier. But we are quite happy at this point in time because the idea is also to ensure that we proactively take care of NIM pricing as well for the customers. In that context, bringing down deposit at this point in time seems a rightful option for us to pursue. The number has come down on contribution basis from 20% to 19% on a consolidated balance sheet. This will go down to probably 16% by end of this year.
Thank you for all that color.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for taking my question. I stepped away from my desk for a couple of minutes, so let me know if any of my questions are a repetition. I can look up the record. So two things I want to understand. First, a clarification. Rajiv sir, you said AUM growth guidance of 23-24% versus 24-25% that we guided last quarter. So is it factoring in the lower guidance given by Bajaj Housing Finance yesterday where they cut?
As I was saying, आप लोग decimal देख रहे हो, हम तो ऐसे एक percentage move कर देते हैं. Don't read anything into it. Wait till Q2 end. We'll also have greater clarity.
Got it.
Right now, as Sandeep likes to say, it's not guidance, it's assessment. The assessment is what we published in as part of Q4 holds.
Got it. No, sir, the only reason why I was asking is, in the past we have seen that whenever certain segments have shown stress, like what you're seeing in maybe MSME and two-wheeler, we have consciously slowed down, which we have shared. So, I mean, are there other levers in other product segments that we can flex to deliver on the assessment that we made in the last quarter?
Like earlier also question was asked, I mean, gold loan is adding net 2,000 crores of AUM a quarter now. And let me make a point. Auto is still adding. So there are the lab, CV, tractor, affordable home loans we are building, that's beginning to add 75-80 crores of volume per month. So we have, we in the last 3 years, I just want to reiterate that in the last 3 years we've launched all that we wanted to launch. And now the entire focus is on optimizing and ensuring that they start to deliver the goal with which they were set up to, which is to generate diversification and to deliver profitability. So no more investments are being given to any of the new lines of business. We have given them enough investment capital. Now they have to deliver goods, and which they are all committed to, or at least are committing to deliver. I have some of them sitting in front of me. That's why I'm making the point. So we have enough firepower to be able to generate the AUM growth. We have to balance it with profit growth. That's the only point, Abhijit, I would make to you. So.
Got it, sir. So the second question I had was about this working capital loans / business loans. I think you yourself acknowledged that every such MSME business owner, right, typically gives out these files to 3-4 lenders. We have heard from multiple DSAs in the past that there was a time, and not very long back, where, I mean, if I were to just quote them, right, iski topi uske sir. So what I'm trying to understand is now that you acknowledge that this storm was sudden, and which is where we are slowing down. I'm just thinking aloud here that if everyone starts rationing credit in business loans / working capital loans, do you think that we might again kind of get into some kind of a credit cycle in this segment? But the reason I ask is we saw that in all other unsecured segments earlier, be it credit cards, be it microfinance.
No, the only difference I would make, this is a customer between 7 to 15 crores of turnover. So he is not the credit card, and he is not the consumption loan customer. I think it's just extremely important for you to note that. He had the ability to borrow, let's say, 60-70 lakhs and pay 60-70 lakhs. This is not an average self-employed customer. This is a 7 crore to 15 crore plus minus customer who can over leverage at times, but who need not fall. So the flow rates will not be if you are alluding. Let me make that point clearly. It's not like STPL conversation. Okay, it's a much better customer quality. That's the nature of the customer. That's why we are offering. We don't offer restructuring in our consumption loans, because if he flows, he flows. Here is a business person who needs to tide over, and that's why we are offering restructuring as an option. We used to do earlier, we used to do lesser. Now we're doing more. So, and we have latitude able to do so. And we need to help that customer because he's a good customer. So it's very different from the past what we've seen STPL or credit card customer or a PL customer.
Got it, Rajesh sir. And then just a related question, because you spoke about leverage even building up in this customer segment where you said, I mean, turnovers between 7 to 17 crores. Just trying to understand. So just trying to understand, I mean, we saw that in a small ticket earlier, right? And now even businesses with higher turnovers kind of showing that over leveraging stress. So if all of this is because of weak macroeconomic slowdown, what is it telling us now about the health of the MSME segment in India?
As I said, it's come a little too suddenly, Abhijit. Wait for one more quarter, we'll have a lot greater clarity. Is all I would say. I think we've discussed MSME is the next frontier today quite a lot. So it's not that amplified to be given that much time. It is an issue, but not. Our bar is very high. We are watching. Let me tell you. Let me make one point that I've not made so far. We are watching offers data on these customers. that's not necessarily giving a good picture. Is the only point I would leave you with. But it's a bias sample. It's a bias sample. I am looking at those who are bouncing. How is their performance? So to be fair, while I made that point earlier, it's a bias sample. The bias sample is not stating a good story. We should do it on full portfolio to see. Yep. No, I was just making a point to Fakhri. If you have a point to make, you can make on full portfolio.
If we just add to what Rajiv has been saying, and I know that we've discussed MSME a lot. So two things as we've talked about, macro is shrinking. 13 out of the 17 industry segments are shrinking. Credit supply, even when you look at credit deployment reports of RBI across these industries, are shrinking. As a result of that, what could be tending to happen is these businesses are facing a higher working capital cycle requirement. At the same time, given the stress that has been coming through with their repayments, banks are slowing down lending to them, particularly in the unsecured space. So it has created a perfect storm. We just need to ride through this, as Rajiv said, continue to watch the vintages, continue to take action in terms of people who are demonstrating leverage levels or affordability levels in terms of their cash flows or debt servicing capabilities, and take corrective action. That's all.
Exactly.
Got it. This is very useful. Thank you so much.
Thank you, Vijit.
Thank you.
Are we done for the day?
Yes, that would be our last question for today. I would now like to hand the conference over to Mr. Ajit Kumar for closing comments. Over to you, sir.
Thank you, Rajiv sir, Sandeep and Bajaj Finance team. Do you want to make any closing comments before we conclude?
Good night is the only closing comment. Long day. And thank you all. Thank you all. Thank you.
Thank you. On behalf of Bajaj Finance Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.